All right, let's talk about Valmont Industries. The stock just popped to a new 52-week high, and you're probably wondering why. Well, the short answer is their latest earnings report was an absolute blockbuster. So in this explainer, we're going to dig into exactly what's pushing this stock higher, and more importantly, what you should be looking for next.
Okay, let's just jump right into the big number, the one that got everyone's attention. 36 cents. That's how much Valmont beat earnings expectations by. They delivered an adjusted EPS of $4.98 when the street was only looking for 4.62. I mean, that's not just a beat, that's a smash. A really clear sign that they are executing incredibly well right now.
And it wasn't just about this one quarter. The real story here is what Wall Street absolutely loves to see. It's the classic beat and raise. Think of it like this. Not only did they ace the test, but they also told the teacher they're going to ace the final exam too. They didn't just outperform, they raised their guidance for the entire year. And that, my friends, is one of the strongest bullish signals a company can possibly send.
So let's peel back the layers a little bit. We're going to unpack the key financial numbers that really lit a fire under this stock. These are the core metrics, the ones that tell the real story of the quarter. Just take a look at this. It's impressive across the board. Yeah, you've got the big earnings beat we just talked about. You've got a nice little revenue surprise too. But for me, the real story, the thing that pops off the page, is that operating margin. It jumped 120 basis points, up to 13.5%. What does that mean? It means for every dollar they sell, they're keeping more of it as profit. That points to some serious pricing power and just incredible operational efficiency. And here's the other shoe dropping, the raise part of our beat and raise story. Management jacked up its full-year earnings guidance. The new target is now $19.10. When a company does this, they're basically telling the market, hey, that great quarter we just had, that wasn't a fluke. We see this momentum continuing. It's all about confidence. All right, so if we dig a little deeper past the headlines, a really interesting story starts to emerge. It's almost like a tale of two different companies living under one roof. And believe me, this is the core dynamic that all the serious investors are zeroed in on right now. So on one hand, you've got the infrastructure business. This thing is the powerhouse, the growth engine of the company, chugging along with a solid 6.6% sales growth. But on the other hand, you have the agriculture segment, which actually shrank by 9%. It's stuck in a bit of a cyclical slump. But here's the key takeaway, the big so what. The infrastructure engine is so powerful that it's more than making up for the drag from the ag business. And this chart right here, it just perfectly illustrates why that infrastructure performance is so incredibly important. It's the lion's share of the business, making up about 77% of total revenue. It's like having a massive locomotive at the front of your train. When that main engine is firing on all cylinders, it can easily pull the entire train forward, even if one of the smaller cars in the back has its brakes on. Okay, so given this dynamic, what's the game plan? How is management playing this? Well, let's take a look at their playbook. It's actually pretty straightforward and clear. They are leaning hard into their strength and getting ready to ride this massive infrastructure wave. I mean, you don't even have to guess. The CEO, Abner Applebaum, basically laid it all out on the conference call. The entire strategy revolves around dominating the North American utility market. And why? Because it's going through what he called an unprecedented investment cycle. Think about it. Data centers popping up everywhere, companies bringing manufacturing back on shore, the whole grid needing a massive upgrade for electrification. These are huge multi-year trends, and Valmont is right in the sweet spot. And this isn't just talk. Here's the plan in action, and it's a smart one. Step 1, they're expanding capacity, but they're doing it the smart way, with brownfield projects, basically upgrading what they already have for a faster, higher return on investment. Step 2, they're attacking bottlenecks in their factories to boost throughput. Just getting more stuff out the door faster. And third, and this is clever, even in that weaker ag segment, they're not just waiting it out. They're focusing on the really high profit stuff, like aftermarket parts and tech. It's all about maximizing profitability, even in a downturn. And is it working? Well, the proof is in the pudding. The company's backlog, that's their book of future orders, has ballooned by over 20% just since the end of last year. And guess what's driving it? Almost all utility demand. For an investor, this is golden. It gives you fantastic visibility into future revenue. It's not guesswork. It's a confirmation that their strategy is perfectly aligned with where the money is flowing. Okay, so we've got all the pieces of the puzzle. Let's put it all together and form our forward-looking view. This is our take on what really matters as we head into the next quarter's report. So, After a quarter this strong, after the stock has already run up, what's the big question on every investor's mind? Simple. What's the verdict? Where does Valmont go from here? So here's our call. We're rating Valmont as an outperform. Why? Because the core story here is incredibly strong, and frankly, their execution has been just about flawless. Now, let's break down the thinking behind that rating. The bull case is just really compelling. You've got a company that's a leader in a multi-year utility supercycle. Check. They've proven they can grow their profit margins. Check. And that huge backlog gives them a clear one-way for growth. Check. Now, what about the bear case? Well, the timing of that ag recovery is a big question mark. And of course, there are always macro risks or the chance they stumble while trying to expand so quickly. But when you weigh it all, for us, the bull case just clearly outweighs the risks right now. All right, so that brings us to our plausible trade idea. The whole thesis is about one thing: capturing this massive multi-year utility supercycle. Now, one interesting way you could think about playing this is with long-dated call options, also known as LEAPs. We're talking options that don't expire for another 18 to 24 months. And the thinking here is pretty simple. It gives you leveraged exposure to that core infrastructure growth story, but it also defines your risk. It lets you ride the big wave while looking right past any short-term choppiness from the ag cycle.
And as always, just a quick reminder, this is not financial advice.